Cisco's setup blends steady-scale fundamentals with measured momentum. Market cap sits around $267.83 billion, with enterprise value near $280.80 billion, while the 52-week move of about plus 30.36% and a 5-year beta of 0.99 keep volatility close to market levels, rather than high beta tech swings. Technically, an RSI near 49.59 and price riding the 50 DMA around 68.12, above the 200 DMA near 63.20 frame, a balanced tape, shifting the focus to valuation, cash generation, dividends, and near-term catalysts. On valuation, the trailing PE is 26.57, with forward PE at 16.75 and PEG at 2.68, implying the market is underwriting EPS improvement at a reasonable but not deep value multiple. Enterprise multiples: EV sales 4.96, EV EBITDA 18.26, EV EBIT 22.44, and cash metrics like PFCF 20.16 and POCF 18.87 point to a quality compounder priced for mid-teens earnings and disciplined capital returns. Profitability remains a pillar. Gross margin is about 64.94%, operating margin 22.09%, and profit margin 17.97%, consistent with a durable networking, security, and software mix. Over the last 12 months, revenue reached approximately $56.65 billion, with net income around $10.18 billion and EPS near 2.55, supported by EBITDA of approximately $15.38 billion and a clear path to fund both product and shareholder returns. Cash generation is a standout. Operating cash flow of about $14.19 billion and CapEx near negative $905 million delivered free cash flow around $13.29 billion, translating to an FCF margin near 23.45%. At current levels, the FCF yield is about 4.96%, aligning with P/FCF near 20 and supporting a thesis of sustainable dividends and buybacks without stretching the balance sheet. Cisco holds approximately $16.67 billion in cash against approximately $29.64 billion in debt, for net cash of roughly negative $12.97 billion, or about negative 3.28 per share, while working capital cites near $78 million, balanced but not net cash. With current ratio at 1.00, quick ratio 0.80, debt equity 0.63, debt EBITDA 1.84, debt FCF 2.23, and interest coverage around 7.86. Leverage is conservative and serviceable through typical cycles. Returns and efficiency metrics: ROE approximately 22.06%, ROIC approximately 10.15%, ROS approximately 14.35%, asset turnover approximately 0.46, inventory turns approximately 6.08. Reflects steady operating discipline as the portfolio tilts further to software and subscriptions. Productivity remains solid, with revenue per employee around $657,239 and profit per employee near $118,097 across roughly 86,200 employees. Institutions own about 78.47%, with insiders around 0.05%, and float effectively equals shares outstanding at approximately 3.95 billion, supporting deep liquidity and broad sponsorship. Shares have declined about minus 1.58% year over year and minus 0.25% quarter over quarter, while short interest is approximately 47.60 million, about 1.20% of shares, with 2.21 days to cover, more fundamentals-led than squeeze-prone. The dividend is approximately $1.64 per share for a yield around 2.40%. Backed by a roughly 63.92% payout ratio and 14 straight years of dividend growth, anchoring the income case in tech. Shareholder yield runs near 4.00% when combining approximately 1% buybacks with the dividend, consistent with FCF capacity and a disciplined capital return framework. Price has advanced roughly plus 30.36% over 52 weeks, with beta approximately 0.99 and RSI approximately 49.59, suggesting a constructive but not overextended setup into the next catalysts. Key dates include the estimated earnings on November 12th 2025 aftermarket, and the October 3, 2025 ex-dividend date for income time positioning. Street consensus is buy, with an average price target around $74.94, or roughly plus 10.61% implied upside, alongside 5-year revenue and EPS growth forecasts near 5.35% and 17.38%. Risk markers show an Altman Z-score of 2.66 and a Piotrowski F-score of 6, indicating average financial health that rewards ongoing balance sheet discipline. Net-net, Cisco screens as a cash-generative, dividend-reliable compounder with reasonable forward valuation and conservative leverage, where returns should be driven by execution, FCF-funded capital returns, and steady margin discipline rather than a big, multiple re-rate. In the near term, a balanced technical posture supports a pragmatic plan. Accumulate on dips, watch margins and free cash flow, and use earnings and guidance on November 12th to validate the trajectory. This content is for educational and informational purposes only and does not constitute investment, financial, legal, accounting, or tax advice. All investments involve risk, including possible loss of principal, and past performance is not indicative of future results. Views expressed reflect opinions as of the recording date and may change without notice. No representation is made regarding accuracy or completeness. This channel is not a broker-dealer, investment advisor, or fiduciary. Viewers should conduct independent research and consider consulting a licensed financial professional before making any investment decisions. The creator or affiliates may hold positions and discuss securities and may change such positions without notice. This is not a solicitation or recommendation to buy or sell any security.